Good morning, good afternoon, and good evening to all of our attendees of TD's Virtual Energy Conference. For those of you who don't know me, my name is Linda Ezergalis. I'm the Energy Infrastructure Analyst here at TD Securities. I am very pleased to have David Smith, the CEO of Keyera, joining us for an update on how Keyera is doing right now, as well as insights on the outlook for both his business and industry. So welcome, David. Thank you for joining us.
Thank you, Linda. I appreciate the opportunity to be here. Thank you for holding the conference again, even though it's virtual. Virtual Calgary Stampede is not quite as much fun as the regular things, but hopefully we can do it in person next year.
Yes, agreed. Thank you. I'm going to kick it off with a few questions, but the audience will be typing in their questions, so I'll start asking them as they come in. Maybe we can start with what's top of mind for everyone. Given the current stage of the global COVID-19 pandemic, can you talk about how Keyera is operating today and how this has evolved since the pandemic was first declared in early March? And from a silver lining perspective, maybe there's some processes and mobile technologies that you've accelerated use in and actually might stick even when the pandemic's over.
Sure. Well, I think the first thing I would say is that right from the beginning we have been focused on health and safety as our top priority, as it always is. We shut down the office, and basically all of the office folks have been working from home since March the 16th. At our field facilities, of course, they continue to operate. They are all essential services, and we have put in place pretty much every precaution we can think of to try and keep the virus from affecting our operations, eliminating all non-essential people, maintaining as much physical separation as possible, managing shift changes so that there's no interaction between the shifts, and creating contingency plans so that we can deal with any situations where employees have to be isolated. I'm pleased to say that the Keyera team is still COVID-free, and I think that's a combination of good planning and good luck that we have not been affected by the virus within the company. So that's been our top priority. I think as we have learned how to collaborate within the teams as well as with our customers and suppliers, working remotely over the course of the last 3 or 4 months, I think we, as you pointed out, we've learned some things about how we can be more efficient and more effective when working remotely, and I think safer too in terms of being able to eliminate non-essential travel. And I think that will help us as we go forward to be more effective and efficient as an organization. Through this process. We are, the leadership team at Keyera is back in the office. We have been taking a gradual approach to bringing people back into the office and testing our safety protocols and making plans for the eventual return to the office of the broader employee base. But we're taking a very gradual and voluntary approach so far with respect to that, and I think we're going to take the lead from the healthcare professionals in terms of what's the appropriate pace of bringing people back to the office.
Good. Glad to hear everyone's safe. Maybe looking beyond operations to the longer term, how does COVID-19 and the commodity price shock inform your corporate strategy going forward? And what's your outlook for the industry over the next year and maybe even beyond then?
Well, that's a big question, and there's still lots of uncertainties associated with that. I mean, what I can say is that we've been doing a lot of scenario planning over the course of the last 4 months. We've met frequently within the team and with the board of directors to assess what the various potential future scenarios look like. We made a series of tough decisions through April and May with respect to the organization and deferring capital projects, reducing staff. We have, in our gathering and processing world, which I can talk about some more, we have made the decision to suspend operations at 6 of our gas plants. that is not directly resulting from the COVID situation, but I think the COVID pandemic has certainly strengthened our resolve that that's the right thing to do. We've seen a steady decline in throughput through our facilities over the course of the last 4 or 5 years as a result of the slowdown in drilling activity. And these were steps that were just the right thing to do from the long-term point of view to make sure that we are as strong an organization as possible as and as things recover. I think we're going to be very well positioned to be able to take advantage of the opportunities that present themselves. In terms of our outlook for the industry, we certainly we're already seeing the signs of recovery in terms of demand for the products that we handle, and a recovery in terms of the commodity prices, which makes things more healthy, makes a more healthy picture for the producers who are our customers. We don't have any material amount of volume shut in at this point. Volumes have pretty much recovered, with the exception of condensate, which I can talk about as well. Volumes have pretty much recovered to where they were, before March. But what has not recovered is drilling activity. And quite honestly, I don't expect that we're going to see a quick rebound in drilling activity until such time as the producers are a lot more confident in their own financial health and in the outlook for commodity prices. So our expectations for volume growth and cash flow growth, particularly within our gathering and processing business, are probably a little bit more conservative than what we would have thought back at the beginning of the year. Having said all that, I think we are certainly seeing positive signs. We're very encouraged to see the Trans Mountain expansion going ahead. We're encouraged to see the Kitimat LNG project moving ahead, and of course the Coastal GasLink pipeline that will feed the Kitimat LNG project. And I think all of these are signs that we take as very positive signals for the longer-term outlook for the Western Canada Sedimentary Basin.
Agreed. Now, maybe we can just revisit your facility consolidation plan. Your initiatives to reduce costs, do you think you've substantially completed that in April and May, or do you think there's more potentially to be done then?
Well, I'll separate it into two parts. I think the broader operating and G&A cost reduction initiatives that we undertook in May, I think those are, for the most part, completed. We don't anticipate any further across-the-board reductions in headcount. There are some savings that we're continuing to pursue that are non-headcount related, but I think that is largely completed at this point. The facility consolidation program, though, is ongoing. We've announced we've already suspended operations at Nevis and Gilby and Minahet Buck Lake. We've announced that we have plans to suspend operations at West Pembina later this year, and at Ricinus and Nordegg River next year. And we are looking at ways in which we can consolidate the throughput at those facilities into other Keyera facilities in the network. Keyera has the unique advantage, because of our interconnections in our south region, that we can accommodate most of the volume at other facilities with a minimum of capital investment required to be able to move those volumes to another facility. As an example, at Gilby, we've accommodated roughly 95% of the throughput that was originally going through Gilby into our Rimbey gas plant through existing gathering systems, so we didn't have to make any material amount of capital investment to do that. We are looking at additional facilities. We're not finished yet in terms of the decisions to try and optimize the capacity. The reality is that the throughput and the utilization levels at those facilities just doesn't justify us continuing to operate those plants, and so our approach is to hopefully retain the volume, as I've mentioned, but reduce the number of plants operating and eliminate a significant amount of the fixed operating costs associated with operating those facilities, which will reduce the per unit cost for our customers, but also will significantly improve our bottom line as we eliminate those costs. We can't quantify that just yet, but we're working on some quantification of the impact of all of that that we expect to talk about in conjunction with our Q2 release in the first week of August.
That's helpful context. Thank you. And maybe are you able to elaborate a little bit on the outlook for condensate as well?
Yeah, I mentioned that briefly. That's the one area where we have seen reduction in volume, and that's a direct result of the reduction in bitumen production from the oil sands that took place in April and May. May was pretty much the low point in condensate demand as a result of the curtailments in bitumen production. We were down probably in total somewhere between 200 and 225,000 barrels per day of C5 plus condensate demand in May, and things have gradually been recovering since then in June and July, as we've seen nominations on our network gradually come back. The balance, what happened to kind of rebalance the market was significant reduction in the imported volumes, particularly on the Cochin system that Pembina operates, but also to a certain extent on the Southern Lights system that Enbridge operates. We did see curtailment of condensate production in Western Canada as well in April and May, but most of that is back online at this point. We would anticipate that at current commodity price levels that you'll continue to see a gradual recovery in condensate demand and in condensate volumes over the course of the next 3 or 4 months. So I would anticipate that by the time the fourth quarter rolls around, we'll be back to where we were in 2019. I should emphasize that from Keyera's point of view, the implications of that have really been fairly immaterial. We have seen certainly less volume on the system, but we do have take-or-pay commitments underpinning many of the transportation arrangements, and so the financial impact of that was fairly small. In the meantime, we've seen a significant increase in the interest in the demand for storage capacity for condensate, as you can appreciate with the rapid disruptions that we saw in March, April, and May. That creates a need for additional storage capacity. We were in the fortunate position of bringing an additional cavern into service at Fort Saskatchewan in that time period, and so we've been able to garner additional contractual arrangements for storage capacity for condensate as a result of the situation that we've been in.
Interesting. Maybe you can touch on caps as well. Obviously, it's a dynamic environment still, but it is a major project, a major strategic project for you that would provide some integration in the services you provide. It has been deferred a year. Any updated discussions with customers, or is it still early days? How might we think of what might prompt a further delay versus getting the green light for that project?
Well, the way we look at it, Linda, is that the project is green-lighted. It's just been, the initiation of construction activities has just been deferred by 12 months. We took the time in March and April to talk to all of our customers, and they agreed to extend their commitments. A couple of them, were probably not completely happy that we were deferring, but they were all still very supportive of the project and understood why we decided to defer. We have all the material regulatory approvals in place, and so our operating plan now is to initiate the construction activities in the second quarter next year, and with the idea that we would be commissioning the pipeline in the first quarter of 2023. Roughly a year later than originally planned. With the downturn in industry activity in Northwest Alberta and Northeast BC, I think it's logical that we would defer the construction from the point of view of the industry doesn't really need that capacity in the same time frame. But also, I think from Keyera's point of view, just in terms of the capital requirement for our 50% share of the construction cost, it just made sense for us to conserve cash flow and preserve liquidity. It made sense for us to defer that capital expenditure until until this time next year. At this time next year, we will have very little in the way of other organic capital expenditures under in process. The Wild Horse Terminal and the Pipestone facility will be complete. Wapiti Phase 2 will be complete this year, and so all of that means that we'll be in a position to be able to fund the CAPS investment next year without having to resort to any additional common equity and without having to look at reinstating the DRIP program. So all of that, I think, it's all sensible and logical in the environment that we're in. But our plan is to be moving forward with construction this time next year. The other thing I would mention is that I'm hopeful that over the course of the next 12 months that we will be able to progress discussions with other producers, both in Northwest Alberta and in Northeast BC, to perhaps be in a position of having more volume committed to the pipeline at that point. But moving forward is with the construction is not contingent on that.
That's helpful context. Thank you. One of the other possibilities, maybe a little bit blue sky or maybe becoming more concrete, is the potential to expand AEF in the future. It has been a strong contributor to your marketing segment. Can you comment on some of the drivers of those results, whether some of them are temporary or permanent, and how that might inform any sort of thoughts about that asset and a potential expansion?
Sure. What I would emphasize off the top is that nothing's imminent, especially in the current environment. I think we need to allow the world supply-demand picture to kind of get back to some form of normal before we make any decisions. But the fundamentals for isooctane production and supply and demand have continued to be quite favorable. We have continued, even through the COVID crisis, we have continued to operate that facility at 100% of capacity. The margins have been squeezed somewhat as gasoline demand has come off quite dramatically. But the demand for the high quality, environmentally friendly, high octane characteristics of isooctane has continued to be encouraging. And I think the way in which the environmental requirements and blending regulations have continued to evolve in North America and elsewhere, I think sets up well for continued strong demand for isooctane or for other other products that can be produced from the plentiful butane supply that we have in Western Canada. So we are looking at a number of different options. The capital associated with twinning AEF is significant. We think that the replacement cost of the AEF facility today is probably about $1 billion. And so we're not about to launch into an expenditure of that size without some significant commitments on the customer side. But nevertheless, I think those are things that we will continue to look at. But I think we need to kind of get through the current period of uncertainty before we make any decisions.
Thank you. We are starting to approach the end of our time, so I'm just wondering if there's any other topics about Keyera or the industry or life that you'd like to highlight that we haven't mentioned as to close.
Well, I guess what I've been telling a lot of people internally and externally over the course of the last few months is, the industry's been through a tough time, as everybody's been through a tough time in the last 3 or 4 months. But Keyera's made some very thoughtful decisions in terms of setting the organization up for strength and success going forward. Our balance sheet continues to be strong. Our liquidity position is second to none.